I can never seem to break 800. I have a mortgage that I pay on time all the time. I have my credit cards that I pay off the statements every month. And I have a lot of credit available to me, like a lot that I don't utilize a lot of. But it seems like high 700s is the best I can do.
I'm going to tell you a little secret.
We're here to help you with that. And if you like that, or that resonates with you, like and subscribe to this channel because that's what we're all about. Who are you and why is it important?
Mary Beth Bain, CMG Home Loans, Middletown, Connecticut. What is important?
No. Okay. So Mary Beth, we met recently.
Yes.
And I wanted to have you on because you have been in the real estate game for a long time. You think creatively about how to get mortgages and deals, which I appreciate because a lot of people are very just not creative.
Rigid.
What? Rigid, yeah.
Very rigid.
Very rigid. Like there's only this one way you can get a mortgage. And after having discussion with you and realizing that you're a wealth of knowledge in the space and some of the experiences you've been having in HOA, right, that are relevant to us, right? And,
correct.
How we're doing the thing. I thought you'd be a great person to have on. Now, we were talking just before the cameras got rolling, and I think that, it could be something a lot of people could benefit from hearing from. So one of the things, what we were just talking about was how to build your credit. So it sounds like a lot of times you bring a deal to the mortgage person and they just say, oh, your credit's not good enough, can't do the deal, right?
Yeah.
It seems like you take a more proactive approach in educating and training people how to build their credit.
Right.
And find creative ways to finance them to get them into a deal when other people can't, right? So tell us a little bit about how, let's start there and then we'll go into how you got into this and then we'll end on what it means for HOAs. Does that sound good?
Sounds like a plan.
Okay, cool.
All right. So you want to talk about building credit? Building credit.
So you got someone who wants to buy a house and they have bad credit, like many Americans. What do they do?
Okay. Couple of things. Time always heals wounds in love and in credit. So the further you get away from an incident, which is a black mark on your credit, like a mortgage late, a bankruptcy, your credit score will rebound over time. But what do you do in the meantime? You want to be proactive in building your credit. People don't understand, oh, I got a credit card. And when I pull a credit report, I see everything you do. I see everywhere you lived. I see your life for about a decade. Good, bad, or ugly. Good, bad, or ugly. And your aliases, too, by the way. That's another story for another time. But just because I see you opened a credit card doesn't have any merit, doesn't move the needle for about 6 months of usage. Okay? So you want to build credit. And the best credit profile, as we were just talking about, is having a mixture of things with various types. Like a mortgage is your heaviest weighted line of credit. Anything large, like a mortgage. Then a large installment loan, like a recreation vehicle, student loans, if they're all lumped together because they individual or one lump. Car loans nowadays are very large. They have been for a decade plus.
Now, are you saying like the total amount on the total loan, or they have a very big impact regardless of how much you've financed on the car?
The biggest weights are in order to get the highest credit scores, your 850 being your max, to build up to it takes multiple things. One is the type of credit, like I just mentioned. Are you all credit cards? Are you all collections? Are you a mortgage, installment debts, a mixture of credit cards, closed out, old mortgages, closed out, old thing? Age is a huge, huge factor. 2 years plus is your merit. You want to keep, like I always tell people, hey, I'm the queen of 0%. So you give me a new credit card at 0, I'm your girl. I'm going to use it. I put it in my safe. I don't shut it down. As long as you're not charging me a fee for that credit card, no harm, no foul. I keep it in my gun safe, and it just, safe, big safe.
My big safe.
Big safe. And I keep it there because, one, don't want it stolen. I don't want to use it.
Yeah.
Okay? So, but it's aging like fine wine, is what I tell people. It's like fine wine. It's getting better. So, to build credit, you have to have a mixture of types of credit, and then we'll go into usage. But like a young person starting out, like you and I were just talking about, you were on your mother's American Express card, probably you're in diapers.
Right.
And you took yourself off that credit card as an authorized user,
Right.
which is another great way I tell my clients to build credit is, hey, do you have a family member that will add your name? And it has to be an account where your social security is. Like if it's a credit card, it has to be your social in order to show up on a credit report. Yeah. Doesn't mean they have to give you the card, because I've had a lot of people say to me, oh, I like her, but I don't want to give her the card. I go, you don't have to give them the card. It's just your credit transfers over to that person as an authorized user. So in your case, your mother had that credit card since you were probably in diapers. Yeah. And so it was a 40-year-old card, as we mentioned. Yeah. 40 years of history shows up. So it's awesome. It's an awesome way to build credit quickly.
Question on that.
Yep.
As you know, I am a cash first person. I do not like to carry credit or interest. I pay my statements every month. Now, is it hurting me that all my vehicles are either paid off, or if I take out a loan, I pay it off in 6 months, so I don't have any rolling like loan payment on my car? Does that hurt me?
It could, depending on the depth of your current credit. I'm assuming, okay, that you've built up a wide range of credit, like maybe closed old car loans, past mortgages, things like that. Yeah. So you have a lot of credit. Okay. How it would hurt you is if you're building your credit, you're young, and you go, I don't like debt, so I'm going to pay off this car loan in 6 months. Hurt you. Because you don't have the age. Remember, the age is one of the things you need to build your credit score, to get up to that 800. That's how people like me, I'm old. So I have a lot of older credit, because remember, it shows up for 10 years. So I've got paid off auto loans, paid off old mortgages, maybe credit cards that are not active, or are active, just have 0%.
Got it. And so like I just bought a bike in December and I paid it off. I paid it down like 95%, because to get the deal, they need me to make 4 payments, right? Yeah. So I paid most of it down so I didn't have to pay the interest on it, and then just finished paying it off this month. Okay. Does that really help me, hurt me, or otherwise?
If you are, I'll call it thin credit, you're building your credit, yes, it would hurt you because it wasn't 1 year old.
Got it. Now, I can never seem to break 800. I have a mortgage that I pay on time all the time. I have my credit cards that I pay off the statements every month. And I have a lot of credit available to me, like a lot that I don't utilize a lot of. But it seems like high 700 is the best I can do.
I'm going to tell you a little secret. You're like my husband. My husband's like, I got an 800. I go, so great. So in the mortgage world, and we're speaking about the mortgage world, there's tiers of credit. Yeah. Okay. In the mortgage world of getting the best mortgage rate, over 740.
That's it.
So I look at him and I go, well, that's great. I'm still going to get the same rate as you. I'm proud of you, honey. You got that 800. You got it. Let's say I'm a 790 or a 780. Right. Big whoop. Okay. It's kind of like, I want that prize.
It's just bragging rights.
It's bragging rights. It's great. But, I can count, on one hand, maybe 2 hands, the amount of 800s I see. And people get annoyed when their score drops to 798 and have to calm down and say, it doesn't matter. You're still getting the best rate. Yeah. Because it doesn't matter. Because over that tier, and I'm speaking conventional mortgages, by the way, your Fannie, your Freddie, even your VA into your HUDs, it doesn't matter. When you start to get over like that 740, then we'll go into on the mortgage. I know we're digressing from credit, but it has to do at that point with how much money you're putting down. Got it. You know what I mean? You and I both I could be that 780, you could be that 800. You only putting 5% down on a mortgage, me putting 20, you may, lower your rate, may raise your rate a little bit because it goes by risk. How much skin in the game you have.
Interesting. So the lower risk you are, the higher your score would be.
The best rates, when you look and you go onto like Bain or any one of those sites now. I used to say when you read it in the newspaper, but I'm dating myself. So you look at like Bankrate or any of those Google, anything. Those are all for a risk is least riskiest single family owner occupied 20% down with a FICO score exceeding 740. So people go, oh, I saw this rate. I go, then you start to, it's called loan level pricing adjustment, LLPAs, meaning that, okay, well, that's great. It's a single family. But again, you're only putting 5% down. You have a good credit score. Or you're only putting 5% down and you have a 700 FICO score. Still good. But you're going to start paying more in the interest rate because of your risk.
Got it. Okay. So flip it back to you're someone who has credit that's not great and you're trying to get a loan.
Less than stellar is what I call it.
Less than stellar.
You have less than stellar credit.
Less than stellar credits.
Yes.
You can still find ways to get them
Absolutely.
into things. And the reason why I think this is important now, obviously, our market is a little unique here where it's a very hard market in real estate, right? There's just not a lot of inventory. But I think how it relates to HOA is a lot of people are being priced out of the housing market. And so their only option is to go condo route, right?
Yes.
And so when that's, when you're newer, you're millennial, Gen Z, just trying to purchase your first home. And that's really the hardest. Like people who already owned before COVID, like they're doing great, right? Even if they sell, they're still not going to be able to replace it with anything reasonably priced. But they trying to get into or break into the market or get your first home at this, it's a really tough time to do, right? So what are some recommendations? Because, a lot of people are looking HOA, they're looking condo because, hey, they might be able to get into it a little bit cheaper. They don't have to worry about the maintenance. You got factors like HOA fees, HOA dues, credit might not be great. If you have someone that's thinking of going that route, what are like the first, what's the order of operations and what's important on your end? And also like, what are things that they should be looking out for before they make that move?
Okay. You come to me as a client.
Right.
Okay, Jared, you come to me as a client. First thing I'm going to do is pull your credit. Okay. Credit's good for 120 days.
Yeah.
So I'm not touching you again unless I say, hey, Jared, did you know you had this collection? A lot of people don't know.
Yeah.
There's things out there that got by you and you're like, oh, I didn't know that. I'm going to address it. So it's a good time then. And we also have the ability in our industry to do a rescore.
Okay.
So if you had that hiccup that you didn't know about or it was not you, and that's very common. I hate to say it's called the touches.
Yeah.
Like if you're in Middletown and your last name is whatever, Smith or something, and all your family lives around you and they're all Smiths, and you all maybe one time shared a residence or something like that, it's a touch. My ex-husband's credit, he's deceased, he will show up every now and then on a credit pull. And I'm like, we haven't been married in years, but we had something together years ago. So it comes up. So now's the time to go ahead and fix it. Get out ahead of it. Or this morning I have the ability to go in, plug and play, go, hey, you're at a 620. I want to get you to a 660. Is it possible? I plug and play. It tells me, it's called Wayfinder or Rescore Wizard. It comes back and says, hey, pay these credit cards down. Not off, just pay them down. It gives me the levels. I give the printout to the client. I say, hey, do this homework assignment. Do your homework.
Make some extra money, pay these down.
Pay these down. Take some, again, shifting your money maybe from your savings to buy that condo, that house.
Right.
To pay down, so I put you in a better position to be able to purchase.
Sure.
Yeah. So you can do things like that.
That's phenomenal.
It's easy.
It's easy.
Computer. And sometimes the computer gives me an unhappy little face like, yeah, no, Mary Beth, you got no way. And I hate to make that phone call. I just get this little sad, unhappy face.
Like it's not, there's no world
like,
where
no way, Mary Beth.
no world where you're making this happen.
And then I go, okay, have some nails by the house for you. Or see you in a year. Which I will tell that to my clients.
So that's really good insight. So let's say you are your credit's super less than stellar, and you get the frowny face, right?
Yeah.
And you're just like, no, you're not getting a place. How long until you can qualify?
It really varies. There is no carte blanche answer. having been around this business a long time, 43 years. I started when I was 5. That's my story, and I stick to it.
Okay.
Like, I do. It's 5 years old. You have to look at the whole credit report.
Yeah.
Like I just said, hey, I can have the ability to plug and play. I get the little frowny face. Sometimes I can look and say, time will heal it. You got to get further away. Just because you had a bankruptcy and a foreclosure doesn't remove your ability to purchase. It's what is the time frame from it. Like on a Chapter 7 bankruptcy, 24 months for FHA, VA, okay? 36 months on a foreclosure action. People don't realize a short sale is a foreclosure action.
Really?
Yeah, it
I
is.
did not realize
Yeah,
that.
it is. So people say, oh, I gave a deed in lieu. I handed the deed back to the bank. It's a foreclosure action. If they report it, that's the key.
Can you negotiate that with the banks? They don't report
You would have to.
Okay.
It's interesting when I pull people's credit. Sometimes I'll see on time, no late, a gap, because that during that short sale period, before the bank they sell the house, they're not reporting. Then I'll see nothing. Then all of a sudden I'll see 120-day late. They will do that because the minute they're releasing the lien, they're now updating your credit. So it'll be fine, nothing, 120-day late. That's foreclosure action.
Now, does it, like when your underwriter's looking at that, are they savvy to it, or are they going to give you a pass because your bank kind of gave you a pass?
No, there's no pass.
So they see that and they're like, no, I can tell there's
I'm
a
going to tell
short...
you, your credit score is impacted by that. Your FICO scores. Remember, you got 3 FICO scores.
Is it going to be impacted as much as a short sale or foreclosure?
Well, it depends, again, how they report it. If they went nothing, 90 day, 120 days, yeah. But again, we're going back 36 months.
Yeah.
Time will heal from that. If it just happened yesterday, huge impact, like you and I were talking about earlier. You could pay your mortgage on time. Remember, mortgages are the most heavily weighted on your credit report.
Yeah.
Okay? So pay everything on time, basically, is what I tell people. Even make the minimum payment while you're, say, funneling your money to pay off a debt that you really want to get rid of. Pay the minimum payment, because even if you miss that $15 minimum payment, it's going to hurt you depending on where you are in an overall credit perspective.
Right.
So in your case, where you have I sold the house as a short sale, 36 months is the general rule to get you back in the game with an FHA or a VA mortgage. Conventional won't like it. Conventional will say 5 years.
5 years.
5 years. 5 years. So I have a gentleman right now, I told him to see me in 6 months because it'll be 5 years from this 120-day late that he had on his credit in 2020. Yeah. So going back to that is that's the most impactful thing to take away points on your credit score. And we see everything. And people probably know this now. We do everything through automated systems. They're called AUSs. Fannie's is DU, Desktop Underwriter. LP is Freddie Mac's version. We run everything, VA, FHA, through these automated systems. And I'll say, I can look at a loan. I have one on my desk right now. She fits the bucket perfectly for an FHA, CHFA loan. Computer doesn't like her.
Really?
Because it's how her credit is made up.
It's all credit cards?
Or she's had some late payments, maybe some collections, maybe it's the age of her credit. So with CMG, I can only speak for CMG, by the way, and in general terms of underwriting, we underwrite CHFA loans at a 600, okay, for FHA CHFA. So she fit the bucket. Her debt to income ratio fit the bucket, but her overall credit profile, even though it was a 628, she's 28 points higher, didn't like her.
Just the algorithm.
Yeah, it's an algorithm.
Yeah.
Good or bad. Good or bad. So that's when you want to rescore, and I'm the one who gave her something this morning to say, hey, pay these credit cards down. Let me know when you do, and I'll rescore you, because maybe if I give her a 640, it's weird about the little benchmarks, the computer may like her. Now, doesn't mean I can't give you a loan. I can do them as what's called a manual underwrite. I have a veteran right now, sad story, bank screwed around with his credit while he was deployed. And veterans are protected. They are protected for 1 year after their tour. All right? So their loan can get put into forbearance, totally legal, fine. And obviously their time coming back, there's 1 year allowed. And then his employer moved him from Florida back up here, impacted his credit score greatly. So I will have to underwrite that as a manual underwrite because I got the letter of explanation. I got proof of he's eligible as a veteran again because he sold his VA home down there in Florida. But because his FICO score is so low, I'm going to have to do a manual underwrite.
Got it.
So you can do it.
So speaking of that, so I, in my formative, so 24, 25, wasn't great with.
Yeah, you had too much fun.
Yeah, had too much fun, wasn't great with money. And I hired a financial coach, like a personal finance coach.
Okay.
And he was from the Dave Ramsey School of Thought, right? So pay cash for everything, don't have a credit card. And his position was, it's okay, don't have a car note, don't have a credit card, don't do any of these things. When you go to buy a house, which is the only approved form of credit on a 15-year mortgage under that school of thought, right? They say, it's okay, you can just ask your mortgage person to do a manual underwrite on the account as long as your DTI is good and you're financially in good shape. Let's say you had a bunch of money in the bank, you pay everything with your debit card, you've got, is that true? What's your take on that?
It's not, it's a great perfect world theory.
Okay.
It's great. And I'm not dissing Dave Ramsey, but in today's economy, with the amount of student loan debt out there and the rents, look at the rents in Connecticut.
Yeah.
It's hard to accumulate that wealth starting out.
Yeah.
It's hard.
Right.
It's really hard unless you had a leg up. Mom and dad gave you money. I also teach in a real estate school. I go, Mom and Dad want you out of their basement so bad that they are going to gift you the money for the down payment and closing costs.
Right.
I'm also seeing, because of economics right now, I am seeing multi-generations living together.
Yeah.
And it used to be more of a cultural thing, and now it's more of an economic thing, and it makes absolute sense. You combine forces because now you have more streams of income. Even if mom, dad is on Social Security, retired, have a pension, they are the daycare for your children, which is another mortgage in itself.
Sure. Yeah.
Yeah. So it makes sense generation-wise to combine forces to live. So yes, that's a great school, but unfortunately, it's how do you get into that first house?
Got it.
I always say your first house is your worst house because that's where you're laying out the most cash to get into it.
Right.
Except for, there are some great programs. In Connecticut, we have CHFA, first-time homebuyer. You can do 100% financing and cover closing costs. So there's multi-programs within CHFA. Great program, do a lot of them. All right? They won't do a manual underwrite. They're hard and rule. Has to be, the computer has to like you. So in the case of my buyer today, I have to fix her to get her to the point where the computer likes her to make it a CHFA loan. And the reason she has to go CHFA is she just doesn't have a lot of money. So you have to play that game. Again, like we talked about, the puzzle pieces. Look at all the puzzle pieces and figure out how I can move them around to make them fit.
Got it.
And get you a loan.
Cool. And so if someone's in Connecticut, are you just licensed in Connecticut? Or can you
I'm Vermont, Massachusetts. I can underwrite in all 50 states and plus some more. If I am not licensed there, like my assistant's got a New York license and a Rhode Island license, I can refer you to somebody there.
Okay. So if they're in one of, so give me a short list of the states that you are comfortable saying, if you're in this state, we can get you a mortgage.
All 50.
All 50?
All 50.
Okay.
All 50.
So anybody listening to this podcast right now that lives in the United States, if they wanted to find you and benefit from your creativity and kind of your ability to get them into the right product, how can they find you?
Okay. Well, like I said, my office is based out of Middletown, Connecticut, but always call my cell phone or text me at 860-334-1406.
It's dangerous. This could get a lot of views.
I do have spam blocker now. I do call back. I do get a lot of phone calls. So just be patient. Go to my voicemail. As I say to my stepkids, I go, well, you didn't call me back. I go, well, did you leave me a voicemail or a text?
Right.
So if it's not important to you to leave me a message or a text, then, not important for me to call you back because I need to know what you want. Right. And the other way is my email is mbain, MBAIN, @cmghomeloans.com.
And that's the firm you're with?
That's who I'm with, CMG Home Loans. They're based out of California, 30-year-old firm. We are a direct lender. Because I get all the time, who do you work for? Like, where are you getting the money from? I go, from CMG. We are a large direct lender.
Do you guys sell the mortgages to some
Yes,
other?
we can. We have a large, that's why we've been eating up. We're a very large player in the field. In fact, I was with Freedom Mortgage. They shut down their retail division in 22, so we migrated to Homebridge. Homebridge got eaten up by CMG. CMG just ate up Norcom 2 weeks ago. Well, they got out of the game. And you're going to see a lot more retailers floating around. Retail is brick and mortar storefronts. There's correspondent and there's wholesale. We're a large player in all three.
Got it.
Okay, so that's how I can be all over the United States. I would look at your credit and say, oh, you want to buy in Georgia. Okay, let me find you a CMG or in Georgia.
Let's say I got investors, they want to do hard lending or, private money. Can you do that?
Yes. We have a lot of broker connections.
Okay.
We in ourselves do not do. CMG has the whole ability to do bank statement programs, DSCR, profit and loss. We have an appetite, for that. But we also broker to those, for those who are dating themselves, the old subprime, we call them non-QM now. In the mortgage world after '08 with the mortgage meltdown, you have your Fannie Mae, your Freddie Mac conventionals, your VA, your FHA, your USDA. Those are called qualified mortgages or QM. They have very specific rules with them and governing bodies, governing the buildings in Washington set the rules. That's what I say. But then you have what's called your non-QM. Doesn't mean we can't do those bank statements, but then I have those really one-offs.
Yeah.
Like you have a Pulse and a Social and a FICO score, I can get you a loan.
Okay.
Okay, they're brokered. So brokered means I originate it, they're immediately closing it. Most of the loans, like 99% of the loans we underwrite are funded by CMG, either put in our servicing portfolio and possibly sold off. Because right now, to survive in this industry, you do have to create revenue.
Yeah.
People don't realize when you generate a loan, it's actually at a loss.
Really?
Yeah. It's like $2,600 right now per loan on average. Yeah.
So, but you guys get paid, and how?
I get paid. Yeah.
How does that work?
Well, I'm paid by my company. Okay. I am a W-2 because that came out of '08. We can't be 1099s. Some companies, there's a movement in the industry to make it that way. I'm paid by my company, so I'm treated as a W-2 employee. I'm 100% commission, so it hurts if I lose a deal, guys. I don't eat until I close that deal. But again, you have the back office that you're paying for. You're paying for those processes that are salary, those closers, that whole support system has to get paid.
So if they're running at a $2,600 loss per loan, I mean, I'm not.
On the average, it's a $2,600 loss per loan.
So, I mean, I'm not a mortgage person, but I am a business person. Businesses don't like to lose money. So how do they make their money? Servicing.
There's a lot of money in ownership of loans and servicing of loans. Servicing is, I have this mortgage. Think about it. You're less than 20% down. Your taxes and your home insurance are required to be escrowed.
Yeah.
Same as government loans like your FHA and VA and USD have to be escrowed. So here in Middletown, Middlesex County, taxes are only paid January and July 1st.
So they're investing.
They're accumulating every month. Say my taxes are, I'm going to make a number up, $500.
Yeah.
I'm putting $500 in my escrow account.
Every month.
And maybe I'm putting another $100 for my insurance bill, which is once a year.
Right.
So then Middletown will bill CMG and say, here it is, July 1st. That's our next payment. Here's our bill for Mary Beth Bain's house on blah, blah, blah. Send out that money. So we are investing that money.
Yeah, so I love that because, I love that you
love that?
No, I love that. I also love that you brought that up because a lot of people, even in the HOA space, they're like, well, why do I have to pay extra if I don't like the special assessment? You can do installments, right? Yeah. But you're going to pay more. Like even if we're not pulling a loan, like we need the special assessment on this date. And they're like, okay, we can do a 6-month installment plan, but you're going to pay more and people don't understand the velocity of money is important. Yeah. So but the mortgage industry, the entire business model is while that money's sitting in that escrow account for 6 months, it's being invested and generating revenue.
Correct.
And that is, I love that because I think it's one of those things that goes so, I mean, I overlooked it, right?
Yeah.
Like where the velocity of money is so important.
It's huge. Because think about the billions of dollars we are originating.
Right.
And think of the amount of escrow money we possibly are retaining.
Right.
And if you service a loan, like we talked about, that's owning a loan, so we're owning that. Say we sell a loan, okay, but we're servicing it. Like during the bad mortgage meltdown, Fannie Mae got into the business of buying up mortgage-backed securities and mortgages. They were not serviced by Fannie Mae. They're not equipped to be a servicer. They're an owner, okay? So if I default and my mortgage is owned by Fannie Mae, it is on the hook. Fannie Mae takes that hit.
Right.
Okay. So say during that mortgage meltdown time, Fannie Mae positioned themselves, which they never really did before, is to buy all these mortgages. They were serviced by CMG, for example. They were serviced by a Freedom Mortgage. They were serviced by whoever. We were collecting those fees. We got paid to service, so we were double dipping, but it's legal. Yeah. We were getting paid to service. We were getting paid to collect those, so we had those escrows at our fingertips to invest. Art is semi-annually ahead. I call it like rent. Yeah. You're paying ahead to live in that town. Like you pay May 1st to live in your apartment for the next 30 days. Yeah. All right? So we get use of the funds until the time that the town says, hey, pay us. Insurance is annual upon your renewal. Like I bought a house today, May 10th. I owe another year, May 10th, 2025. So CMG would have to send that payment to, whoever, State Farm, Geico, whoever is insuring your property.
So this might be getting too much into the minutia, but would a loan servicing or a lender look at how that particular zip code that you're buying into is structured before they propose the deal? No, they don't.
No, not at all. Okay. It's just because
they're like, if it's quarterly in the rears, we know we can hold it in the account. Or
it doesn't matter. No, okay. Not at all. Okay. Not even factored in. It's just, hey, that's what we do.
Okay, cool.
Yeah.
All right. So we talked about who you're with. We talked about that you've been doing this for
43 years. A few years. I was 5.
You're 5.
I was 5.
So let's jump into the HOA space. So let's jump into HOA and condo or the community association management space because that's been a space where you have been running into issues recently.
Oh, big time.
And we talked about why people might be getting into condos at this time. And then you met me and you're like, hey, this is someone who works in this space who I can ask my questions to. So, and kind of bounce off of. So talk to me about some of the stuff that is blowing up deals in the HOA space and what people need to watch out for if they're trying to get into a condo or HOA.
Okay. The biggest issue you brought up is affordability, is trying to get a roof over your head, buy my property, or retire, downsize. It's very, very important with the condo association, how they're insured, their reserves, their budgets. And lately, the last couple of years, it's becoming very critical that somebody like you is stepping in to help them. Because the biggest pitfalls we are seeing, as it's expensive out there, insurances are rising, costs are rising. So a management, an HOA, an association is trying to cut costs, but they're going to cut their throat. I don't mean to be graphic, but they're saying, hey, the biggest issue I'm seeing right now, one of the bigger issues are they're not funding enough into what's called the reserve budget. And a reserve budget is 10%. Like if it takes $50,000 a year to do the mowing, the landscaping, the blah, 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 to run that complex, keep the pool clean, whatever, it's $50,000, they should be putting 10% minimum in a reserve contingency to offset any future repairs that need to be done. Like you mentioned earlier, those decks, roofs, they all need to be replaced. Weather's not kind up here. But they have a life expectancy. A lot of condo associations are just not doing it. Or they didn't, and now they're caught that they need money to put that roof on, so they're putting special assessments. I looked at one in Bloomfield, the buyer passed on, because the HOA fee was $300, but $300 in special assessments because they neglected their budget, the reserve requirement. Now they have to put roofs on the complex. So he's like, I walked away from that. He goes, I'm not going to buy there.
Right.
Because I can't afford besides the pity, principal, interest, taxes, and maybe having my own personal policy insurance,
right.
I can't afford $600 for
in
that.
Addition, yeah.
In addition, it's actually more expensive to buy that condo than it would be to buy a single-family house.
Right.
Yeah. The other thing is insurance. You and I have talked a lot about. Another way the president, the board, they're trying to save money is they're going for the cheapest insurance. And with that comes a big problem. You have to have replacement cost, okay? And I'm speaking for your regular QM mortgages, your Fannie, your Freddie, your VA, your FHA. You have to have replacement cost. A lot of them are going into cash value.
Can you explain the difference for that?
Replacement cost is today I take out a policy to insure my 50-unit complex.
Right.
Okay, keep going along, prices go up. Labor goes up, material goes up. So 5 years from now, I have a damaging effect, a storm. I have to replace the roof because of whatever. The cost of the roof has obviously gone up. So they haven't kept up with the times. Replacement cost is critical. You want that on a single family policy anyway, because again, I'm getting my house now, but 5 years from now, I have this a tree falls on my roof.
So what's cash value conversely?
Cash value is a lump sum. Cash value is a lump sum. Like, hey, cash value on this. And it's per incident, so it can be low.
Yeah. So my understanding of it is, let's say you have this 70-year-old complex built in the 70s.
Yes.
Right?
Yeah.
All of the units are going for $100,000. So you got 30 units, right?
Yeah.
So that 100,000 by 30 units is $3 million, right? That's cash value, right? That's how much it would be worth today. But if it all burns down and I have to rebuild it, are you going to be able to rebuild it for $3 million?
Yeah.
No. Because of
it's replacement cost.
Right. So it's like $10 million to rebuild it.
Yeah.
But your building isn't worth as much as it is to rebuild.
Right. And you have to look at what's it made of. Is it made of brick?
Right.
Is it made of wood? So when you take a single family brick home versus a vinyl sided home, stick built, they're both made with wood, but what's the facade? Brick, vinyl. It's more costly to insure that single family brick home.
Correct.
Because the lender has a lien position on it. They're going to say, no, we mortgaged this brick home.
Yeah.
We want it replaced with brick. You could say, hey, my house burned down. I don't like the brick anyway. I want to put vinyl so I can power wash it. Lender says, no, it has to be brick.
Right.
So you're paying more.
And the reason for that is like, okay, so a lot of these houses from 1900 were brick, right? How many masons do you know?
In Middletown, a lot, but
really?
no.
There's a lot.
I'm making a joke. Not as many as there used to be.
Not as many as there used to be. Used to be a ton, right?
Oh, yeah.
But how many vinyl contractors do you know? Or how many siding and roofing?
Every day I meet a new one.
Right.
Yeah.
So it's like, oh, yeah, the reason why it's going to cost you 3 times as much to build in brick is because there's nobody to do that work anymore.
Right.
Nobody does
and
that.
the material cost is more.
Right.
Than vinyl.
Right.
And you look at what happened during and after COVID.
Yeah.
The amount of like lumber it went up, really never came down to where that 2x4 cost you prior to COVID. And look at labor. Yeah. There's such a shortage in the trades that, as you and I were speaking of earlier, that you want to incentivize to keep those people. And so it's cost. So it's really, really critical in ensuring what a lot of these complexes are doing. They're trying to save money, and it's not affecting them now in Connecticut because people have a lot of cash. People are waiving contingencies, whatever. what's going to happen is when the market corrects itself and we go back to what's called a normal supply. Okay. Right now, there's no supply.
Well, I don't know that.
Maybe a 1 month supply, but normal supply is 6 months.
Northeast, I don't think is going to come back because nobody's building up here.
No, it has to do with not just building. We don't build. Okay? It's a different problem up here because we have not a lot of new construction like we do in the South where they have the land.
Yeah, and they're just building towns.
Okay, tons and tons and 300-unit projects. Here, there's a normal way. It's just a normal phase of life. People are retiring. So they're selling their bigger home going down south or retiring going to a condo. They're downsizing their large 4-bedroom colonial or job transfers. Mm-hmm. So there's a normal flow in the market of people that have to move out of Connecticut. We'll use Connecticut as my stomping ground. So what's happened is I had a deal fall apart last week. Older woman wanted to downsize. Once she realized what she could sell her house for and what it was going to cost to get her into maybe a smaller house or a condo, she canceled the sale because it didn't make sense for her. So sad. But so we have a normal attrition, let's put it that way, of people moving in and out of the state. You know, age, retirement, whatever. So right now, well, I'll use me as an example. Say I have a 4-bedroom colonial and I'm at 3%. I'll keep my 4-bedroom colonial because I don't want to give up my rate, but where am I going to go?
Right. And where am I at 7%.
It's 7%. But the market is going to change.
Right.
And the market will change. So the sweet spot we talk about in the mortgage industry, it's going to be around 6. Because it's, all right, yeah, I have a 3% mortgage. It's going to cost me 6. But, I can handle that. People are buying in the 7% rate. People are buying. We just don't have enough inventory. Right. So to combat that problem, we have to get more inventory out there. A normal is 6 months supply is what's called a normal. But right now we're at a month. And so it's like a free-for-all, which is driving prices higher because people are overbidding.
Oh, yeah.
Overbidding, crazy.
Because we do, I think I've told you, we do flips. And I've been putting in offers $30,000 over, cash deal, waive all inspections.
Yeah.
Still not getting it.
Right.
Still outbid. I mean, like how, right? It's nuts. It's nutty on houses that aren't worth that.
It's crazy.
Yeah.
And unfortunately, sad to say, some of those houses are going to go into foreclosure.
Right.
People are overbidding. They're getting caught up in the moment. And they're like, oh, my God, I'm eating ramen noodles. Right. And I don't want to. And I got kids. Very expensive.
Kids are expensive.
Kids are very expensive. So it's just everything's expensive. So rates are going to start coming down, not as quickly as we had hoped. We thought we were going to start seeing it second quarter. It's just the Fed with inflation. But we're hoping by the end of June, July, going into that third quarter, we will start to see a rollback, which affects affordability, meaning that, hey, I'm, at 7 1/8, I can maybe only buy a $300,000 house. Rates go to 6 1/4. I now can buy, I'm going to make a number up, 3 1/4, 350. So it affects that.
Now, so I think a lot of people here are, I guess you got mixed people who are worried that the crash is coming, right? The big one, right?
Yeah.
And then others that are, so you're looking at it kind of optimistically, like as the market starts to drop, then more people are going to be able to re-enter.
People don't realize this is not a bubble.
Okay.
Like 08 was a bubble. And what led up to 08 was bad lending practices. Okay? What led up to, you and I were joking about it, I have a pulse. I have a pulse. I have a Social Security. I can get a mortgage. That's what led up to the mortgage meltdown of 08. People don't realize since 08, with the feds, we have some of the best FICO scores out there. If you look at the statistic range of rates, it goes back like 50 years. The average rate is always in the 6s. If you go back and look at the Fed for 50 years, it goes like this, 6. You have to remember, the first loan I ever wrote was a 3-year adjustable at 17.5%.
Yeah.
That was way back in the 80s. The houses were $40,000. But if you look at that, we are not in a bubble, meaning that they tightened up regulations, like that little happy frowny face I just told you about.
Yeah.
We have some of the best credit out there, on average. So what we are not in a bubble where it's going to collapse. We are in an inflationary environment,
Right.
because there's so little inventory. People are overbidding to get that house. All right, and are getting shut out of the market.
Getting desperate.
Having inventory will slow that down. Think about it. Pre-COVID, you had, if you wanted to buy a house, you generally would go out, find the house you like, maybe be up against one or two offers. Maybe. Okay? So now it's like, no, you're up against a lot of offers and you have to have an answer now. And it's just stressful. But we're not in a bubble. People say we are, we're not.
What about like a general debt bubble, or like we're talking about like national debt, stuff like that?
That's a problem.
Yeah.
That's a problem, because going back to I have a 3% rate.
Yeah.
I'm putting everything on my credit cards.
Yeah.
Or I have all this lovely equity in my house that I bought pre-COVID.
Right.
I'm going to take a home equity line of credit.
Right.
Well, people don't realize with a home equity line of credit, they're great, but you only have to pay interest only for the first 10 years. On the 10th year, it becomes, you got to go into a repayment plan.
Right.
So take that $50,000 and now, okay, in 10 years from now, I got to pay it back on a 10-year repayment plan. That's expensive.
Right.
And adding to your first mortgage.
Right. And so we don't have the discipline for it on a personal level, right?
Yeah.
And then I always tell people this, because and this is kind of my soapbox, because everybody wants, in the HOA space, wants to kick the can down the road. Let's specialists.
Can hits the curb eventually.
Right. And the thing is, like, if we look at the trend, like 10 years from now, your life is probably going to be harder. The economy is going to be worse. Like, at least, and even if it's not, right?
Yeah.
Even if it's not doom and gloom, right? Like, that is a potential outcome and possibility. Yes. So now you're pigeonholing yourself into, my life only goes okay in 10 years if by some miracle the economy is better. But if any other outcome happens, you're hit, right?
Yeah. So people could say, I have this 3% rate,
right,
and or I have all this credit card debt.
Right.
So you average them.
Okay.
I always talk to my clients. I go, well, I don't want to get rid of my 3% rate. But I go, okay, what's your average credit card rate? 12%, which is cheap, by the way.
Right, it's cheap.
19, 20.
Right.
Okay, so you're really not paying a 3% mortgage rate. You take all your debt, divide it all
12.
up. Yeah. So, hey, I can get you into 7. And get you that colonial and pay off that debt when you sell your house to get. And that's the other thing, when you qualify a buyer, my puzzle piece is, I say, okay, take some of your money, pay off this one debt in order to qualify to get you into the house you want. So you look at the whole big picture, but people get hung up on, I have this 2.75 rate. But in the meantime, you're leveraging yourself with your credit cards, home equities, and things like that.
Got it.
You got to look at the whole picture.
So next question is, so going back to HOA, another thing that you mentioned, I'm just going to remind you of it, just because I think we got to talk about it.
Okay.
You might have brought it up anyways, is mortgage questionnaires.
Oh, yeah. Going what I said earlier about the boards are trying to save money, so they're going for the cheap insurance.
Yeah.
What they're also doing is, I'm going to say this, and this is a Mary Bethism, they're cutting themselves off the knees.
Yeah.
By a condo questionnaire is very, very important on what we call the QM. Right? We have the non-QM space. If you put 10% down, higher interest rate, we don't care. We don't care how many tenants to owners. We don't care about your budget. We don't care. But you pay a price for that. You have to have 10% down, and they're called non-warrantable condos. The key with the condo questionnaire is it's basically a snapshot at the moment. Doesn't matter if CMG closed a loan in this complex yesterday and today we have another loan. We want to see what's going on. It's what's your reserves, what's your, doesn't even matter that much about owner-occupied to investor ratio. That kind of went away many years ago. But what are your reserves? What's your insurance? Like we just said. Do you have replacement cost? And we're finding that a lot of us, like, we don't want to do these questionnaires anymore. Well, you just made your whole complex non-warrantable. Now, what that doesn't mean nothing right now because people are paying cash. People are, sacrificing their souls to get into this condo. It's going to affect your value when the market slows down to what I'll call a normal market. Inventory is normal. We saw it in Middletown. I don't want to name the complex. I'm going back from the 80s. They did that.
Yeah.
They kept their values at $40,000, where maybe a regular condo would be $100,000.
Oh, I know which one you're talking about.
You know what I'm talking about.
Yeah.
Because they allowed at that time too many investors to buy up.
Right.
So by doing that, they depressed their overall value. So it's coming. So what you do right now to save money could affect you down the road. Kicking that can, you'll hit that curb. So all of a sudden, it doesn't bother the complex now. Like, oh, I don't want like FHA approvals.
Yeah, you don't care.
They don't care. It doesn't affect me. It will care when you go to sell.
Right.
Because you just narrowed your pool. Right now, the pool is, like you just said, I'm paying cash. I'm waiving all my contingencies. I'm a great, wonderful buyer. When the market normalizes and we have a normal inventory, you just took people out of the market that could have bid on your condo. So you coming in, Mr. Cash Buyer, go, I know I'm the cash is king guy. You want $200 for your unit? I'm going to give you $190. And I, as a seller, go, I'm desperate to get to Florida. I'm desperate to get here. I'm desperate to move. I'll take your $190. I just set the tone for my complex as a declining value.
Correct.
And it's key in condos. When you appraise them, you have to have comparable sales within the complex. In a perfect world, all the sales come from your complex. It doesn't mean we can't go out in a radius of like associations, meaning square footage, whatever. But if you have about an abundance of foreclosures, you have sales that you're your own comp.
Well, yeah. And that's part of the reason. So one of the biggest value adds that I don't think we've talked about, but like since COVID, right? The average appreciation of, let's say, condos in Cromwell, what would you say? Ballpark it. 50%, 60%?
Oh, God, yeah. I'd say 50% conservatively.
Right. So in Country Squire, which I think people know, right? From taking over in 2020 to today, we've had over 100% appreciation on all the units, right? Why? Well, we fixed the investor to owner occupant ratio. We took advantage of COVID, right?
You fixed the budget.
Fixed the budget, fixed common elements.
Yes.
Got paid off the special assessment loan,
Right.
right? So it's like...
Looked at the insurance component.
Correct. And so... when people say, hey, we just want the cheapest management company. Well, where do you pay for that? And you're after value. I bought into that complex at $62,000 in 2020, right? That same unit goes for $125 now.
Right.
A one bedroom, or it's almost a studio size, but it's a one bedroom base ground level apartment, right? Or condo, sorry. So what's the delta? What's the difference between Country Squire and, the condo complex down the street? Just the management company,
right?
How it's being run, right?
Correct.
How we're budgeting. So the people who took, I don't want to say the risk, but let's say I charge a little bit more for management than your bottom of the barrel management company. The benefit of that is what's 50% of their appreciation, $30,000. So maybe they pay an extra $2 a month in management fees.
Correct.
Right? Like per unit. But their ROI on that over the last 5 years has been $30,000 of extra value on the smallest unit, right? Their 2-bedroom townhouses are, maybe it's $50,000 in added value just from good management.
Right.
And I think a lot of times that goes overlooked is your management company or so that other complex we talked about, that they wanted to save money on a property manager, so they promoted one of their internal people who doesn't want to fill out mortgage questionnaires. Now they can't get mortgages.
They can't get standard mortgages.
Can't get standard mortgages.
You can't. Well, they did two things.
Right.
They dropped. They were built. What were they built in the 80s?
Yeah.
They were built in the 80s. They did what's called a HUD approval. So you had a lot of first-time home buyers going in there, FHA, CHAFA, whatever. They dropped the renewal, a year and a half ago? So, okay, fine, market's supporting itself, conventional, doesn't care, cash, whatever. When the market flips back to a normal market, you just kept that whole segment of buyers out. And in your case, when they promoted somebody to get rid of the management company, they're not doing the questionnaires. You took another segment of the market out. Your normal Fannie, Freddie.
Right. You can't get a loan on it.
You can't get a loan on it.
And it's not.
Unless you go non-QM 10% down with a higher rate.
Right. And it's not that hard to fill out the mortgage questionnaire. So my question to you is, trying to wrap my head around this, why they would be advised not to do this. And are they worried that to be honest, they're not going to get approved anyways? Or are they worried that they're going to mess it up and put the wrong thing on there and then be held liable?
I think it's the liability. Really? I think from a legal point, they've been advised, do not put anything out there because you will be liable. You could be liable.
Now, how often are the lenders holding because I mean, it's not a sworn, it's not stamped, it's not, notarized affidavit.
It is not, exactly. It's just like at that moment in time.
To the best of your knowledge.
To the best of my knowledge. And again, we are not in Florida.
Right.
So large lenders, Fannie and Freddie have their own very specific, if you go on their website, your large lenders who service create their own. So I'm just going to digress and talk about Florida for a second. That was horrible what happened.
Surfside, right?
Surfside, yeah. We just, to the best of your knowledge, do you know of anything? No. To the best of my knowledge, no.
Right.
I don't.
When's the last time you had an injury report? I don't know. I honestly don't know.
So we don't care.
Right.
So what I'm saying, to the best of my knowledge, as a representative of this complex,
right,
I don't know. So the form says how much in your reserves, the 10% rule we talked about, what's your insurance requirement, I think it's up to how many numbers of people are 60-day delinquent paying their HOA fees. And that's a fluid number, by the way, because if I fill out this HOA fee on the 1st versus now the 10th, you might have made your payment.
Right.
Because you have a grace period. Right. So it's totally different numbers. So it's at the time.
Yeah, they want to see that not half the complex or a third of the complex is 3 months in the rear on their dues, and the complex is going to run out of money.
Well, also it shows you have a complex that is mismanaged. What all these forms do is when you don't have reserve requirements, you have severe delinquencies, you have a mismanaged complex, which is going to go in the hole. Ag is problems. Even a lawyer would say, I've had lawyers pull clients out of deals because when they look at it, they go, this complex is going down.
Right.
Yeah.
So plug for a good management company.
Yeah, it's a very good plug. And that's why I'm so grateful I met you, because you bring something to the table where everybody's trying to save money. Right. We get it. It's the economic time, and they want to self-manage those smaller ones, but you don't know what you don't know.
Right.
Unless you've been in this gig, right, you've done this, do you really know the importance of what the right insurance is?
Right.
Or maybe you don't want the liability, air quotes, of filling out that questionnaire.
What's the implication?
Well, like you said, you're going to condense the buyer pool, and I'm going down the road when we're back to normalcy of which usually in the buyer pool, when you do that, you lower your values.
Right.
You risk lowering your values, like the one we were talking about, which we didn't name. They're still impacted. They're still less than the average condo in the Middletown area.
Correct.
They are.
Yeah.
And this has been the 80s.
Right. And so let's look at that, right? So I always saw rob Peter, pay Paul, or penny wise, pound foolish, right?
Correct.
So it's like, okay, you are saving, let's say you're saving $100 a month on your HOA dues, right? So instead of paying $375, you're paying $275 because you found all this way to get bottom of the barrel vendors.
Yeah.
So your total money saved over 12 months is $1,200. Now, if that affects your property value, which is potentially $100,000 by 30%, in that same time frame, you've saved $1,200 and lost $12,000.
Correct.
Right?
Yeah.
So I think it drives me nuts because I think people don't realize.
They don't realize. We should do a lecture series on that, because yes, you're comfortable now.
Right.
And you're controlling the board, or you're living in, I don't want, and people, I get so angry, and this is a personal thing. I don't want those FHA people. Like, I was an FHA person once.
I was an FHA.
I was a first-time buyer once.
Yeah.
And FHA has no negative connotation. It's just a way to lend.
Correct. And usually it's great for first time.
Great time, because it's 3.5% down, lower FICO scores. mom and dad want you out of the basement so they can gift you. And again, if you had some issue in your life, through a bankruptcy or foreclosure, something
Divorce.
bad happened, medical, that you went through a bankruptcy, divorce, whatever, foreclosure, time heals it. You can get, those loans are more forgiving. And so what I'm saying is we all bleed the same. Doesn't matter. Life has hiccups. So I get angry when people say, well, we don't want those kind of people. What kind of people are those?
Yeah.
Yeah.
The only kind of people that I don't want in my complexes, which is funny because I am one, is investor. I don't want investors. I don't want investor owners. I want owner
That's
occupants.
another rule with going back to the questionnaire.
Yeah.
How one entity can't own more than a certain percentage. So say you have a 10-unit complex.
Yep.
You're the investor. You owe two.
That's 20% of all the votes.
20%. You just squelch that condo complex.
So what's funny? In my first year in this business, before I actually my first year, I came at it really from exclusively an investor perspective. And I'm gonna share, if someone has taken the time to get this far in the podcast, they're gonna get a little nugget that they could take over the world with. Not that I want them to, but and then I switched sides. I changed sides from the investor side to I'm on the HOA side now, right?
Yeah.
Like I'm trying to support them. But let's say you have a 100-unit complex. Your participation rate in that 100-unit complex is probably like 5 people, 10 people that really care. So you're all the votes, there's only really 10 people that have any say in anything.
Right. They control the narrative.
They control the narrative. Now you buy 3 units of the 100, 4 units of the 100, and you show up to a meeting, and when it comes down to votes, there's 10 people, you get 2 other people to agree with you, and you carry 4 votes yourself. You can control the destiny of a 100-unit complex with 4 units.
Good or bad.
Good or bad, or otherwise.
Good or bad.
You can run it how you want to run it.
Yeah.
You sometimes even 2 units, right? If it's really low participation, you're an investor, you have 2 units in a 50-unit complex, nobody else cares. Yeah. You show up and you bring majority of votes to any table, right?
Exactly.
And so that was kind of a strategy that I toyed with early on, but then I realized that there's all these drawbacks, and ultimately the associations that are in the best health have the highest ratio of owner occupants, because in general, they're owners, they're living there, they care more.
They care.
The tenants don't care.
They don't care. Yeah. It's like having a rented house. I have a lot of my clients that are, I got them in young, and they're like, oh, I want to keep my house. I have a 2.7 and I can rent it for this. I go, that's great, but you travel all the time. So the tenant's going to call because the dishwasher's not working. You're flying all over the world.
Right.
Okay, are you going to pay somebody to do that?
Right. People think real estate is passive income. Being a landlord it's not passive. It's not. And unless you have impeccable selection in tenants, which I promise you don't, the HOA is going to be finding you for all the stuff they do, if they're a good HOA. And if they're not finding you and you're not getting calls and your tenants are running amok, then it's just destroying the quality of life for the people living there.
It really is. And a lot of people, a little spin on this, because I'm big into reverse mortgages. Yeah. 10,000 people a day are turning over 65.
Okay.
So think about lifestyle. You're going from that 4-bedroom colonial to, I don't want to mow my lawn. I want to travel. Right. I don't want to shovel. I'm too old. My back hurts. I want to go into a complex, somehow an HOA, PUD, whatever. But again, can I get into that? Because I still have to have certain criteria. Okay? So you have to have certain criteria. The reserves, the replacement cost on the insurance, there's a lot to go with it. So those people that are sitting there going, I don't want to renew my FHA, because I don't want those type of people, you will be that person. But you'll be older, maybe well off. But what if you want to downsize and go into a different unit? Florida has a lot of problems because of mismanagement down there.
It is I had some people.
It's the Wild West.
I have some people that are up from Florida, contractors, and they're like, oh, in Florida I'm like, dude, please don't use Florida. I actually kind of like Florida, but it's just it doesn't apply here.
It doesn't apply here.
No.
And the weather doesn't apply here.
Right.
And so we fortunately don't have those hurricanes. I always say we're boring New Englanders. We don't blow away tornadoes and hurricanes, and we don't fall into the sea, California. So we have different issues up here. We have
inundated with water.
Ice damming, things like that. We have different issues. But every area is different, and it is the Wild West. And unfortunately with Surfside, that put a microscope, a lens right on inspections, concrete, quality, things like that. Do we have those high rises? Yeah, maybe in the cities.
Yeah.
But generally we don't have that issue. But it's important it's maintenance. Going back, this is all about maintenance. Those common areas have to be maintained. Like if you have a house, if you don't maintain it, you're going to pay for it down the road. Right. So same with these complexes. So they're throwing aside and making it deferred maintenance. It'll come and bite them. And again, what cost? Today's cost, 10 years down the road cost.
Right. Now, question on that. Two things. One, on the mortgage questionnaire, you have how many, I want to circle back before I forget, how many units are 60 days delinquent on their HOA dues? Mm-hmm. And then right under that is how many foreclosure actions have been brought? Mm-hmm. So my question is, I've always wondered whether that question, do they want to see that you're foreclosing on it or not?
It would come up anyway. If it was on the market, it would, the appraiser possibly could pick that up if the unit was on the market. If you have a lot of foreclosures, the trend is telling the lender you've had a problem.
Got it. Okay.
That's it.
So it's not like, hey, you've got 10 people that are 60 days past due, but no foreclosures. Why are you not doing your job?
That's right. Yeah. It's like what I said. On the first, maybe the dues are due.
Yeah.
And there are 60 days, but you have a grace period to pay the dues by the 10th. So they pay them. So tomorrow I do the same questionnaire. I've done that before. I'll resend the questionnaire.
Got it.
And you got a totally different number.
So they would want to see. So if I have 10 units that are 60, I don't.
Yeah, we're making that up.
Right.
Yeah.
If I had 10 units that are 60 days delinquent, they want to see that there's one foreclosure or 8 foreclosures on those 10 units.
They don't want to see any foreclosures.
Really? Okay.
They don't want. No, but I'm just saying, Mary Beth, looking at this, have not had a deal blow apart because there was a foreclosure in the associate. I've never. I'm having deals blow apart because of this insurance issue.
Right.
And other things that are going on.
So the main ones are insurance.
Yeah.
The resale, reserves, and mortgage questionnaires.
Doing them.
Not doing them.
Just not doing them.
Right.
Because they feel that they're getting guidance that, I'm opening myself up to liability. No, you're not.
Right.
You're just answering a question.
Well, if anything, I think you're opening yourself up to D&O liability because you're not managing properly. And if people are materially damaged because they can't get the value for their house that they're supposed to get because you didn't fill out the mortgage questionnaire, they can file a D&O claim for the amount of damages or difference in property value.
They are going to see that. You and I have had this discussion is right now it's not because I can sell it to a cash buyer. When the market goes back to a normal supply and demand, or somewhat supply and demand, normal, that's when they're going to start getting lawsuits.
Yeah.
That's my thought process on that.
So, I had another really good one for you.
Okay.
Totally blanked on it. It'll come back.
Talk about something else that'll come in your head.
Yeah.
That's what I always tell people.
So we got the mortgage questionnaires, the reserve studies, and the blanking on that.
We got reserves. We got the mortgage questionnaires. We have insurance.
Insurance. That's what it was.
Yeah.
Okay. Now, what do you think is so where things are going? What are the most important pieces for people to what kind of complexes are you trying to? Do you ever see someone trying to purchase a property and you're like, hey, listen, I wouldn't buy here?
I'm not allowed to say that.
Really?
I'm not allowed to say that. I'm not supposed to undue influence. Neither are realtors.
Really?
It's the old term was redlining, where you don't want to live over there. You want to live over here. It's steering. Redlining was a term. God, I can't even think of the year. I'm dating myself. Redlining is lenders wouldn't lend on the other side of the tracks because of whatever. population, ethnic, whatever. That's redlining.
Even in a condo complex?
It's a geographic. It's a geographic. Look it up. It's an old term, redlining. I'm going back from the 70s. Like certain lenders would not lend in certain areas because of maybe a higher ethnic population. So banks would get slammed now, but that was called redlining. Steering is the word. Like, hey, you really don't want to live over there. You want to live over here.
Even if you're looking at the financials and you're like,
I don't look at I look
the
at
questionnaire and you're
this is what I said for generations, so purple people don't get offended. I said, I don't care if you're purple with a third eye in the middle of your forehead, as long as you have a social and you can prove to me by pay stubs, W-2s, tax returns, you can afford to repay this mortgage, you're good. I use that because, again, I don't care if you're purple with a third eye and you just beamed in from Mars. If you have social and you're here legally, and you can support it's called the ability to repay ability to repay law, really came out heavily in '08. I refer '08 after the mortgage meltdown. This is where a lot of the stuff came in, FACRA, ability to repay, that I as a mortgage lender, if I didn't follow my due diligence, and that's why we have checks and balances in my business. We have underwriters. Like I may say, oh my God, I love Jared. Jared's a great guy. Give him this money. But Jared can't afford it because his pay stubs, W-2s, tax returns, however you're supplying your income, can't afford to repay it. We have to deny the loan.
So my question is then, if you're a buyer and you're looking to buy, and your realtor can't tell you, hey, listen, I wouldn't buy in this complex because the financials aren't good. They can't say that either. Like who can tell you, hey, listen.
A lawyer can.
A lawyer can.
A lawyer can. Okay. We are actually, like we were talking about this morning, the deal that I brought to you. I have a fiduciary responsibility to my client. My client is the person, the mortgage holder, not the real estate agent. Right. She might be my friend. He or she may be my friend. I don't have a fiduciary obligation. My obligation is to my client, the borrower. Right. So what happened this morning? I get an email from the condo department saying, hey, Mary Beth, we can't lend on XYZ because they don't have replacement costs. They have cash value.
For their insurance policy.
For the insurance policy. So CMG cannot offer Fannie, Freddie financing on this complex. So these are the laws. We are not violating anything. Because people will say, oh my God, you're discriminating against me because it's only a $100,000 condo. No, I'm not. These are Fannie Mae and Freddie Mac rules. Just like there'd be HUD rules, VA rules. We are adhering to the rules of what's required. Now, sometimes there's one-offs. This is not a negotiable item. In the case of a condo, it has to have replacement cost insurance. It can't have cash value.
Right. Because if the whole place burns down, you can't replace it.
Correct. There's a cap. So we'll be left with a pile of rubble. Going back to that single-family brick house, single-family vinyl. Yes, we will rebuild the house, but we want it with brick, so you're going to have to pay for it. But you might say, I don't want it. But no, we have a lien on your property. People don't understand. You could have a 30-unit complex, and there could be 30 mortgages out there. So each lien holder, each mortgage company, that owner of that mortgage, you are the owner, but there's a lien from that lender has a stake in that complex.
Right. Now, I also want to point out for people listening, because we're going to have a lot of board members and people who are in HOAs who maybe are running into these same issues. Deals are falling apart.
Yeah.
Or maybe, they're on the board and they don't realize deals are falling apart under their watch. The board and the manager have a fiduciary responsibility to the association.
Correct.
And so if people in your association, unit owners in your association, are materially damaged because of things that you are doing or are not doing correctly, you can be sued, right? And I just want to, I know we alluded to it earlier, but I want to reiterate that. The reason why we make this content for people is so that people are aware of what they should be doing, because it is a responsibility when you're on the board and you make these decisions. And if you're not informed, when that suit comes in, and if you're already messing up this one thing, you might not even have a D&O policy in place. You might just think all you need is your master. And so when you get sued because a unit owner, lost $50,000 of value on their property because there wasn't the right master insurance in place, and you don't have a D&O policy, and now you're personally going to come out of pocket for legal costs to defend yourself and what you were doing. Like, it's a thing.
It's a thing. It's a little off, but look at the NAR real estate lawsuit that happened in Missouri.
Okay.
Sellers were, in Connecticut I have to commend Connecticut. They did a great job on disclosures, meaning that, hey, you're listing your property, you're signing, and it comes down to a checkbox, but a good realtor would say to you, hey, Jared, you're putting your house for the market, and we're giving I'm going to say 6% commission. Be aware 50% of it's going to go to the buyer agent, the one who procured that buyer to go to you, to buy your property, okay? What happened in Missouri is it wasn't explained properly, and many years later, they just won bazillions of dollars, and it's upended the whole real estate business nationwide. Not so much in Connecticut because we were doing the right thing from what I could see with realtors. So if you're the president of an association, it could happen. And this took years, and they got that lawsuit through. So it could happen.
Right.
So just because it's not happening now, it could happen.
Right.
So you're better to defend yourself and you don't know what you don't know, but doesn't mean you're off the hook because you don't know.
Correct. Yeah. And this isn't to scare people away from being on the
No,
board, because we
not at all.
want good, qualified people listening to this stuff to be on the board. It's just highlighting the importance of, get educated, learn to do the right things, have a good property manager. If you don't, subscribe to our course. The membership is nominal, right? And you will get all this content will be put in there in a linear way, so you will know what you should be doing to be successful.
What I say to everybody is surround yourself with trusted advisors.
Right.
In the real estate community, like I said, I do a real estate course. I go, you want to surround yourself with that home inspector, that attorney, real estate. I mean, I happen to have been a realtor too, so I understand a lot of it, but times change. What was, good and acceptable under FHA 10 years ago may not be now, or vice versa. Like, there were some old rules with FHA about you had to leave the refrigerator, you had to leave the stove. No, those are gone. They got changed like a dozen years ago. And I still get calls from realtors going, they're selling, but there's no stove. Yeah, so, it's like, doesn't matter. So surround yourself with trusted advisors like what you're offering with, hey, you may have a good handle on this, but I'm really not sure if I know this area over here.
Right.
That's very...
Absolutely.
And
and another thing worth mentioning is, so when you subscribe to the community, you get access to the training modules, but you also get access to other professionals or advisors in the space, like you, right? So Mary Beth's part of the community. So when someone jumps in and has like a mortgage-related question and puts that in the comment thread, Mary Beth's going to get an email, and if it's something that she knows the answer to, she can chime in and answer that question or that comment that was posted to the thread.
Or I could seek out the answer.
Or you could seek out the answer, right? And so, and between, as the community builds, with both professionals in that space, as well as other HOA board members who might have experienced similar issues, it becomes this group that is able to advise each other well, right?
Yeah.
Moderated by people who are in the business, moderated by myself, and really with the value add of other people who are doing this every day to say, hey, listen, this is something we've seen before. I can give you good advice on
Exactly.
that. Right.
Because you may never have had that issue come up, and all of a sudden you're faced with it, and it's like, at least you're offering a platform to seek out the answer. And like I said, I may not know the answer, but I have enough resources behind me to go get the answer.
Correct. Yeah. Absolutely.
That's what we do.
That's what we do. And that's why I'm so focused on building other people that have that knowledge and resources that I might not, right? Because I think I know a good amount, but there's stuff that I don't know too.
Yeah.
There's stuff, we all have blind spots. So
the cash value thing has been rearing its head. I never heard of it.
Right.
Prior to this last year. Yeah. Just never heard of it. And all of a sudden it's rearing its head this last year because perfect example is last year I closed in Cromwell. I can't think of it. I'm not going to name it, but it was a Cromwell complex. I got a call from a loan officer doing a loan, very seasoned pro, different mortgage company. He goes, how did I close this deal in June? I go, I don't know. I just closed it. Well, what happened is September 1st, they changed insurance. Their fiscal year, they changed. They went to cash, not replacement. So he couldn't do the loan, even though I just lent on it 2 months before because they made that change in the association. So going to like what we were talking about this morning, I said to my client, call whoever you know, the board, president, whoever, and just say, will they make a change? But I never heard of cash. Because to me, it was insurance. Oh, you have insurance. That's great. I went happily along, and now it's rearing its head a lot this year because they're just trying to save money, but they just don't know that how much it's impacting people mortgaging, obtaining financing on these condo complexes, and how it will impact their values further down.
Yeah.
Yeah.
100%. Cool. So I think we're getting up to where we should be time-wise, probably a little past it.
Okay. Whatever.
And no, I think, but I'm just thinking that there's still plenty to talk about, so we'll probably just have you back at a certain point. But one more time so that everybody listening can find out your name, where you are, and how to find you.
Okay.
Okay.
I am Mary Beth Bain of CMG Home Loans here in bright and sunny Middletown, Connecticut. That's where my office is. But I'm nationwide lender. And you can, I'll give you my cell phone, 860-334-1406. My husband sometimes answers because I'm doing something. I go, answer the phone. He's used to it. And my email is mbain, BAIN, at cmghomeloans.com.
Fantastic. Thank you so much. And, thank you for taking the time to chat. I think whoever takes the time to listen to this is going to get a lot of value out of it.
It's all about education.
That's
I
exactly right.
preach education.
That's it.
I just preach it because it makes you a better consumer.
Yeah.
Like, I love it when a client calls me and maybe the agent referred him to me, but they've already talked to one or two lenders. I know I spew a lot because I got so many years of doing this, and I go blah, 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 blah. When they go, wow, in 10 minutes you told me more than all the other lenders told me, I go, well, this is what I do.
Right.
I give you the condensed version of this is what you can do.
Right.
Yeah.
And the thing is that in today's day and age, with the access to social media, with the access to internet, right? Like,
don't get me Dr. Google. Well, I have a bump. Right. I must have leprosy.
Right. No. And so there's it's a double-edged sword, right?
It is.
But we have access to knowledgeable people.
Yes.
Like more so than we ever did before, and there's no excuse not to educate ourselves on these things that we should know about.
Right. Or ask a trusted advisor.
Because
if I don't know,
it's free.
It's free.
It's free.
It's what I do. And like I said, if I don't know the answer, I go up the food chain to that area. And because I've called people this morning and they said, I don't know, call this person. I go, you're right. I'm going to call them. Because sometimes they're so intricate. And I find myself to have done this over the years. You just accumulate that knowledge that I may say, I think the answer is this, but let me confirm. Because things change.
Got it.
Okay.
Cool.
All right.
Well, I appreciate it. And
Anytime.
I will see you this Wednesday, next Wednesday?
Yeah, this Wednesday.
Nice. Bright and early.
Yeah.
All right. We'll talk, all right?
Get over it. Thanks, Jared, for having me.
All right, no problem. Thanks for coming.
Take care.
You too.
Bye-bye.
We'll catch you next time. Thanks again. This is Jared with HOA Crusades. We'll talk to you later.